Hey everyone, and welcome back to another video for today. So as we prepare ourselves for the last month of 2025, let's look at some quality companies that have seen their stock go down this year, have not really been participating in the bull market, but I do think that they might surprise a lot of us in 2026. Now, of course, I might talk again about PayPal, but no, I will talk about these three companies right here. I do hope you keep watching, and if not, at least leave me a like and a comment and maybe come up with your own companies that have been underperforming the market this year, but you think they will outperform the market in the upcoming ones. And also a friendly reminder, Fiscal.ai still has that promotion going on, 30% off any plans that runs until Monday, December 1st, 11:59 p.m. Eastern. Any plan, me personally, I have Enterprise, which is the highest tier, but I got it complimentary. Pro is good enough, plus new users, new members will get Fiscal Pro for free to try out for 2 weeks. So give it a try. There's a link in the description and in the pinned comment. Everything you see in my videos anyways comes from that platform. So if that's good enough, keep watching the video. But if you do want to become a better investor, because that's basically why you're paying here, go give it a try. Again, link is down in the description and in the pinned comment. 30% off after Monday, it's back to 15. All right, so first up, let's talk about Salesforce. Salesforce, as you can see, the stock is down 30.3% year to date. Now, important to note, Salesforce will report their quarterly figures next week on Wednesday. So you might want to buy it before, or you want to wait until you get more information and then make your moves afterwards. Yes, it is very possible that you're going to pay more for a share of Salesforce or pay less. It is up to you. But right now, Salesforce has a market cap of $219.4 billion, PE 33.5 times, forward PE 19.3 times. Of course, an amazing margin profile. I was very surprised to see that the return on invested capital, the 5-year average, sits at 3.8%. You would like to see this number go up substantially over the next couple of years. Now, the problem with Salesforce, of course, has been the slowing down of revenue growth. Now, luckily for us, we're not investing in the Salesforce of the past, but we're investing in the Salesforce of the future. And the Salesforce of the future, according to them, is going to be a Salesforce where growth should reaccelerate. And currently, if we look at some pricing metrics for the company, I mean, the forward PE is well below the 9-year, 10-year average here. The forward free cash flow yield is also very high compared to the average, 6.64%. Price to free cash flow, also forward one, is well below the 10-year average. And then when we look at the operating margin, this thing continues to go back up. This is over the last 12 months, just to show you the evolution of that metric. 20.2% as of last quarter, free cash flow margin 31.6%. This is a company that also uses their free cash flow to buy back shares, pay a dividend, and yes, M&A, of course. Gross profit margin, huge rebound from that bottom year, Q2, Q3 2022, back to 77.6%, and net profit margin closer to 17% as of last quarter. So margin-wise, incredible stuff from Salesforce. Now, we've seen the 5-year average for return on invested capital was quite low. If you look at the last 12 months, that is higher than the 5-year average, sits at 7.6%. So it is improving. You would like to see that number continue to improve up and to the right. Now, over a month ago, Salesforce held their investor day, and they, of course, talked a lot about Agentforce. Now, remember, Agentforce is expected to contribute way more to the business starting fiscal 27, which starts February 2026 for them. It is contributing already right now to the business, but not much. Starting fiscal 27, that should impact the overall business much more. And of course, the numbers, everything that they gave us with regards to the business, they say everything's going the right way. Now, luckily for us, again, we don't have to wait that much longer until we actually see what the business has been doing, because they will report their quarterly figures on Wednesday. But in the meantime, they have set longer term targets already. So they believe that by fiscal 2030 or in fiscal 2030, excluding the acquisition of Informatica, they will be generating over $60 billion in revenue. That's over 10% organic compound annual growth rate from fiscal 26 to fiscal 30. That's not all. This is what they think will happen. Delivering the lean agentic enterprise profitable growth framework, according to them, subs and support constant currency growth plus non-GAAP operating margin would give them 50 by fiscal 2030, basically the rule of 50 for them. And the last pillar here is, of course, capital allocation, so continued free cash flow expansion, reducing SBC as a percent of revenue going forward, and this, yes, does include the acquisition of Informatica. Now, currently, what we can clearly see is that growth has been decelerating, right? And that has been the issue around this company. But according to the current analyst expectations, growth is expected to reaccelerate from here with regards to revenue. Free cash flow is expected to grow faster than revenue here as well. This is a very profitable business. Again, they use the free cash flow to buy back shares, pay a dividend, and yes, they do acquire other companies. Now, as of last quarter, the remaining performance obligation stood at close to $60 billion. As you can clearly see, the January quarter is where RPO peaks, and then it does drop 3 quarters in a row, and then we're back to a bigger quarter. Now, if we go and do a quick reverse DCF here, terminal growth rate 4%, I'm taking here the 10-year yield, we can change that to 2% in a bit. The discount rate is basically the terminal growth rate plus the implied risk premium, 2% dilution. You can see that to justify today's price, the free cash flow growth every year for the next 10 years is less than 8%. Now, if you say, okay, let's put terminal growth rate at 2%, and maybe, yes, you know what, maybe discount rate, let's put it at 10%. So how fast should this company be growing to justify today's price? Well, it should be growing at around 9.2% every single year for the next 10 years. And if we put it at 10%, then today's price should be around 6.2% higher than where we're at right now. Do you think this is too much to ask for this company? I don't think so. Moving on to the next company, and that's the Trade Desk. The Trade Desk has been completely obliterated this year, is down 66.4%. Over the past 5 years, you can see what has happened with the stock. Not a lot, right? At one point, it was up significantly, right? At one point, this stock was up 67%. Now it's down 56.1% over the past 5 years. This is a company worth $19.1 billion. This is usually a company that is trading at a very high premium, which is why you've seen the stock being completely obliterated this year. Because you can trade at a premium if you continue to, well, deliver the goods and grow at a rapid pace. Now, they are still growing quite rapidly, but they are growing slower than before. Also, at the start of the year, they did have a small miss, their first miss in 8 years. That miss got corrected 3 months later, which is why you have seen that the stock did go up 3 months later. But then, yeah, it became more and more expensive, and yes, growth did slow down a little bit. And so now we're back here at around $40 per share. If you look at the margins of this business, of course, it is a high margin business. It is a profitable company. The forward P is, of course, much lower than the almost 10-year average. Forward free cash flow yield is, of course, higher than before now, still sits at 4.71%. Forward price to free cash flow, of course, there is, when you're not really generating any free cash flow, there will be a period where this number makes absolutely no sense, but we are still much, much lower than even during normal periods. PE, trailing PE, 45 times. Yes, here as well, there were some periods where there was no E, so you're seeing this abomination right here. As for return on invested capital over the last 12 months, that still sits here around 25%, more specifically 25.7%. Looking at margins, operating margin 18.9%, free cash flow margin did drop 24.7%, gross profit margin has also been dropping here, and net profit margin did stay stable at around 15.7%. Now, this is of course on a last 12-month basis, so we can look here at quarterly and see what has happened with gross profit margin. We can see that Q1 is usually that quarter where gross profit margin does take a big hit, and then the 2 quarters that follow, usually you see a rebound. That did not happen this year. Now, why did that happen? It is investment related, more specifically Kokai, CTV, AI related expenses. So yes, we do expect margins to go, gross profit margins to go back up. Now, for the trade desk does anticipate accelerated growth in 2026, driven by several structural shifts and foundational improvements made throughout 2025. With the trade desk, of course, we've talked about the open internet versus walled garden players like Google, Meta, and Amazon, right? In recent quarter, especially Amazon has been mentioned quite a lot. They think, and this is basically the difference between the trade desk and Google, Meta, Amazon, these types of players. So the trade desk focuses on the open internet, while the others do focus on, well, their own businesses, so search, YouTube, Prime Video, Facebook, Instagram, Reels, etc. The pricing tactic for the trade desk is that price does reflect value and efficiency, more on that in a bit. And as for the others, they often price their DSPs near zero, which is basically a trap, to funnel spend into their high margin owned inventory, especially with Amazon, right? Amazon, a lot of the ads there are running on Amazon.com and Prime Videos. Now looking at Q3, revenue only increased 18% year over year, or 22% if you of course exclude the political spend from last year. Now as for Q4, revenue is expected to grow at 18.5%, also here excluding political spend. Now, when we look at the investments that they've been making, of course, Kokai here is one of those. So we'll talk here about the price reflects value and efficiency. So the widespread adoption of the AI-powered Kokai platform is the single greatest performance driver for clients. Their reported benefits include 26% better cost per acquisition and 94% better click-through rates. New products are designed to clean up the ad tech supply chain and increase transparency. So you have OpenPath, Open Ads, PubDesk, and DealDesk. They enhance supply chain efficiency, improve price discovery, and increase campaign efficacy. OpenPath's particular has grown by many hundreds of percentage points this year. So of course, with all that said, you do expect that this company's revenue growth will start to reaccelerate from here on out, and especially in 2026. Now that we are lapping those quarters where political spend in 2024 was much higher. But as of right now, the analysts are not that convinced. You can see that growth is expected to stay around the same for fiscal 25, 26, and 27. When we look at revenue, free cash flow is still expected to grow faster than revenue, but then only grow 11.7% in fiscal 27. And here, if we do a quick reverse DCF, terminal growth rate 4%, discount rate 8.73%, I did here add a small execution risk. To justify today's price, they'll have to grow free cash flow each year for the next 10 years by 10.8%. Is it possible? If they execute well, I do think it's possible, and I do even think that they could surpass that number. Moving on to the last one, and that's Netflix. Netflix, of course, did have a reverse split, so now shares are trading at around $107. Now, year to date, out of the three, this is the one that is still performing very well, still up 21.5% year to date. But if you look at the drawdown, it's currently experiencing almost a 20% drawdown from the peak back here in June. Now, Netflix is already a $455 billion company. Margin-wise, quite good across the board. I'll show you that in a bit. Trailing PE 45 times, forward PE 35.1 times. The current average analyst price target does sit quite higher than where we're at right now, at 134.4%. And here as well, out of the three companies, it's still the company that is expected to grow faster than the others, top and bottom lines. If we look at the forward PE and compare it to almost 10-year average here, we are of course much lower than that. Free cash flow yield on a forward basis sits at 2.46%. Price to free cash flow, again, there were some periods where free cash flow were thrown out of the window, so it's a bit strange, but we are, let's say, in line here. PE, trailing PE 45 times is of course also lower than the average, but also here around, I would say, what we are used to. Looking at margins, in this case, over the last 12 months, things get better and better. Operating margin 29.1%, free cash flow margin 20.7%, gross profit margin 48.1%, net profit margin sits at 24% as of last quarter. and the return on invested capital sits at 22.7%. Now, last quarter, revenue did come in line with expectations. Operating income would have exceeded forecast absent to a one-time Brazilian tax expense. They are on track to more than double ad revenue in 2025, and some analysts are already putting ad revenue estimates for 2026 at around $4.5 billion. The Brazilian tax expense is covering periods from 2022 throughout 2025 and is not expected to have a material impact on future results. Analysts are still expecting this company to grow revenue 15.5% in fiscal 25, only 13% in fiscal 26, and then close to 11% in fiscal 27. Free cash flow is expected to grow much faster than that, 29% in fiscal 25, almost 35% in fiscal 26, and then close to 19.5% in fiscal 27. Doing a quick reverse DCF, you can see that Netflix, to justify today's price, they will have to grow free cash flow each year for the next 10 years by 14%. Is it possible? I do think it's possible. Anyways, they're expected to grow much faster than that number over the next couple of fiscal years. Of course, the further down we go, the growth rates are probably going to drop here as well. You might say, yeah, but again, the terminal growth rates, in my opinion, is a bit too much. Let's put there 3% in Netflix case. Okay, 3% there. Here as well, let's put here a discount rate of 10%. And then we're getting here 22.5% growth to justify today's price, which is high. But that does become 17% if we do adjust the discount rate to 8%. So you can play around with reverse DCFs. I just think that Netflix is just a tremendous business that does become better and better over time. I do think that the cost of creating content will come down because of AI. You might like it, you might dislike it, but we're looking here at a business that, in my opinion, will continue to grow, will become bigger, does have, yes, the ad-supported tier. If you don't like ads, you'll pay a premium. If you don't mind, then they'll make money from the advertising. And so all in all, that's about it for me in this video. If you want me to rank the companies, I'd probably put Netflix number 1, Salesforce number 2, and The Trade Desk number 3 at the moment. Let me know what you think down in the comment section below. Do check out fiscal.ai, 30% off, still available up until Monday. Link is down in the description and in the pinned comment, and we'll see each other in the next one. Bye-bye.